Eric, it's great to have you back. Thanks for the time.
Great to see you, Carl.
Well, if we're just talking a lot about a recessionary scenario right there. How does advertising, and I guess specifically Meta, hold on if that in fact happens?
Well, I think we're going to see downside nodes to numbers if we get a full-blown recession. I think equity investors believe that's a near certainty. The channel check work and the industry work we do would tell you that's still a bit of a work in progress. When we look out over this quarter that they'll be reporting in the next 3 weeks, we actually came away that the prior guidance given by Meta did not have to be changed. And as a result of that, we like the risk reward of the stock here and going forward. Similar to what Dan just said in the segment before me, Facebook or Meta and Alphabet can now also be valued on GAAP earnings. They both trade at reasonable multiples to growth. On the other side of any recession we would see, they're both buying back stock. And the large-scale players typically operate better through a recessionary period. And we have 08 and 09 to go back and look at as examples of that.
Do you think they're making aggressive enough moves on costs to where that growth doesn't outweigh revenue growth over the next couple of years?
I think there has been a steady stream of press reports in the last couple of weeks around Meta aligning revenue growth with expense in a way that looks like they're taking this fairly seriously in terms of remaining flexible. Alphabet still talks about investing for the long term on their most recent earnings call. But even if you go back and look at prior periods like the first half of 2020, when we had the pandemic or other growth slowdowns, all of these companies tend to slow hiring, slow sales and marketing. But it does appear from some of what we've seen in press reports coming out of Meta that Meta might be taking that slowdown a little more serious and more aggressively aligning costs. But we'll have to wait to see what the management commentary is in about two and a half weeks' time.
Eric, from the investor perspective, I want to talk about what's broken and what's not in the social space, because no matter which of these companies we're talking about, they're all affected by these questions of targeting, of attribution, and even in Twitter's case, this bots thing is kind of about the real value and real growth of users over time. Who's really got value in the space? Were those who thought that Google had missed the boat on social actually wrong, since Google's got YouTube, and that seems to be doing relatively well?
Well, I think there's a couple things here. I think on social in particular, there were benefits from the pandemic as people were staying at home and looking to be entertained. And frankly, a lot of user growth happened, a lot of time spent happened, and you're burning off a lot of that as the world reopens, hopefully on a permanent basis, and we don't go back to being more in a lockdown mode. That would be number one. Number two, you've had a rise of competition. You have an asset like TikTok coming out of ByteDance in China that has seen a lot of user growth, a lot of time growth, and alongside TikTok, you've seen the rise of short-form video, which could potentially be cannibalistic of long-form video and other social media habits. So I think what's happened for investors are you've had targeting changes from Apple, call into question monetization over the short to medium term. I think you've had competition increase, call into question the long-term terminal value, and then you've had some just post-pandemic normalization themes. People have got to get comfortable with all of that. And when I go out and talk to a lot of investors, the lack of visibility into linear results acts as a headwind to this group. So I think what you're seeing investors do is they're defaulting back to, if I can value it on a risk reward basis on 2022 or 2023 earnings, GAAP earnings, then I'm willing to wade into a name. But the extent to which you move further up a P&L and try to value a company on a revenue multiple, it falls out of favor.